Hi, my name is Tim Chance. I am a staff attorney with Maryland Volunteer Lawyer Service, and today I wanted to briefly discuss reverse mortgages. So, a reverse mortgage differs from a traditional mortgage in that it is essentially a loan against the equity in your home. So, instead of taking out a loan and making monthly payments to repay the loan as you would with a traditional mortgage, with a reverse mortgage, you can convert the equity that you built in your home into either cash or a line of credit. So there are requirements that must be met in order to qualify for a reverse mortgage. Firstly, you must be 62 years of age or older. 2, you must reside in the property as your principal residence. And 3, you must own the property outright or have paid off the majority of the existing mortgage. Another important requirement is that prior to getting the reverse mortgage, you must obtain counseling from a certified reverse mortgage counselor. So there are benefits to a reverse mortgage. You can use those funds to pay costs that otherwise may not have been able to have been paid, such as any costly repairs to the property, healthcare costs to yourself, or even using the money to pay off the existing balance of your traditional mortgage. But just as there are benefits, there are cons that require a certain level of consideration and a great deal of thought beforehand. Firstly, the loan is going to need to be repaid at some point, and the loan's balance can grow over time with interest, fees, or if you continue to make additional advances. So one scenario that could trigger the loan becoming due is the death of the borrower. So once you die, the loan generally becomes due and owing, and your surviving family members can sell the home to repay the mortgage. But in that case, they're not able to keep the property. So that's one thing to consider, is if there is a reverse mortgage, you're looking at the possibility of not being able to leave the property behind to your heirs. There is an exception if you are the surviving spouse and the borrowing spouse passes away. As long as the surviving spouse generally continues to make upkeep payments such as insurance and property taxes, the loan can be deferred throughout the course of the surviving spouse's life and become due and owing after that spouse passes away as well. The loan can also become due and owing if you no longer reside in the property as your primary residence. So residency must be proven annually, and if you fail to properly recertify, that could trigger foreclosure. Lastly, you must continue to make the payments associated with the upkeep of the property. So if you fail to make your homeowner's insurance, or if you fail to pay your property taxes, that could potentially trigger the repayment clause of your mortgage. So when considering whether a reverse mortgage is right for you, you need to carefully weigh all of the potential implications. And that's why it's so helpful and beneficial to speak with a reverse mortgage counselor beforehand. You can find a certified HUD Reverse Mortgage Counselor near you by calling HUD at 800-569-4287.